Hey everyone! I can't tell how happy I am to be with you guys today with the third session of Trading with Indicators. I'm sure you watched last session and did your task that I have told you, and as a review, I must say that the last session we talked about simple moving average and moving average explanation. Both of these indicators are important and frequently used indicators that you can see on most of the charts. Today we will talk about the third moving average, which is called volume weighted moving average, abbreviated to VWMA. Now, what's this and what's the usage of it? I'm sure you remember we said SMA and EMA are paying attention to the price and they get an average of price level. Now, VWMA considers the volume factor, and the volume plays a major role in the output of this indicator. Alright, let's see how to apply this indicator on the chart. Let's move to my screen now. Alright, let's see. We move to the indicators section here again and type simply VWMA instead of writing this long name here. I just click on it and it's going to be added on my chart. Yes, it's added. I want to make some edits on it, so let's make it a little bit bold here. I mean the line. And here it is my moving average. Also, you can see the volume directly through the time. So we come to the indicator section and choose the volume as I had chosen one as one of my favorites. So I click on volume and it's added here on my chart. In order to make it much more clear for you, I come to the style section of volume in the settings and I increase the opacity, bring it here and make following one here and change this to area. I think it's much more visible for you here. Okay, now let me show you an example. If we come to right, it's a very good place for an example. Here you can see the amount of money traded in the market has gotten high, and so does the indicator. So we can conclude this indicator as a factor that takes the average price and volume in a specific period of time. As we are having a look at the indicator's settings, I mean here, you can see the previous same options that we have already talked about. If you miss them, you can simply watch our previous videos in which we talked about the length, the source, and offset. Just consider the point that, again, your length should have correspondence with your time frame. It's not recommended to use midterm length in scalping time frames like 3 or 5 minutes. Now you know 3 types of moving averages along with an indicator to help you spot the swing highs and swing lows. But it doesn't matter to know the names, I've mentioned it several times during the Market Touch course that the names, lines, and graphs on the chart won't bring us money. What is crucial is to know how to use these for your benefit and be able to earn money from that. The main usage of indicators is that they can be used as a kind of, support or resistance line, yet dynamic. There are a set of rules that can confirm our analysis. I'm emphasizing again, these are just confirmations of your analysis, and the rules that I'm going to talk about cannot solely be the base of an analysis. So, the first rule is that once the price starts to move above the moving average, the trend tends to be bullish in that specified time frame. Similarly, once the price goes below the moving average, we can say that the trend is getting bearish in that specified time frame. For more elaboration, let's move to my screen. Alright, in order to elaborate this example for you, I want to move to the Bitcoin chart. So I type BTC USDT, here it is. And we move to the Bitcoin chart and we are in 1 hour time frame. I want to add an EMA on my chart. So I come to the indicator section and I type choose the moving average exponential. And here it is. It's added on my screen, but it's not visible. So I want to make it a little bit bold here. Yeah, it's much more clear. Okay. You can see here, it's a very useful point that I want to share with you. You can see that the indicator is recognizing all minor waves as well, even though we don't need them. So I have to change the time frame to be able to get major swings in this time frame. The best number for hourly time frame is 50. Let me change it to 50. It's much more perfect. The indicator, how can I say, disregards the very minor movements of the price, and it detects only the major ones. Here also you can see the major bumps and dumps of the price as well. So now let's say you are not a short-term trader, and as an amateur trader, you need to start with bigger time frames. So I move my time frame to daily, and the moving average here is, somehow useless for me, as you can see. 1 second. Yeah. So what I have to do is to change the time frame length in order to correspond it with my time frame. We have already talked about the best lengths for each time frame last session, and we said that for daily or weekly times, higher lengths like 100 or 200 would be perfect. So I set my length here for 100, and pay attention here. It's applied, and you see the indicator is showing much more major movements. In order to see the difference, and in order to elaborate it more for you, I move to the style section. Let's make it yellow and a little bit bold. We are in daily time frame, okay? And look to the 3 length. The indicator will be applied now. 1 second. Yeah, here it is. You see the indicator has gotten closer to the price, detecting all waves, all minor and major waves. But we don't like that in daily time frame when we want to, generally open positions in spot trading. And if I move to 100, the change would be totally remarkable for you. Okay, yeah, you see? And the other point that it's really important for us is the points that the price surpasses this line. For example, here might be a very good example. You see, the price in this section, the price has gone down and is below the indicator, below my EMA, and continues to pass the line. It's getting closer to the line, but it's not coming below it, and it's going up again. And here you can see the price is getting further from my EMA. So it's a very good sign to get a buy position. I mean a long position. And as you can see, the price is jumping until here, and this is the point where the price, after a long time, comes below my EMA. So I'm sure you can guess by now that this is, a short signal. And it shows that you can get a short signal, but in a spot trading. You can see that the price is decreasing here, and it's coming up again. It's again a buy signal. After a pullback, you can also enter in these areas, and you can get this much profit. And it's getting closer again. These are some, breakouts and failures that we have already talked about us in our course. Totally. These are the examples. For example, here it can be a very good signal because the price is getting further and it's getting much more below the EMA line, and it can be a very profitable short signal.
All in all, the points that the price collides with the line play a major role in indicators.
The second technique that we can use while using indicators is using multiple moving averages in a single time frame to confirm or reject the trend continuation. I mean, if a moving average with lower length is above the one with higher length, it can be a sign of continuation of a bullish trend. And vice versa, if a moving average with higher length is above the one with lower length, it can be the sign of continuation of a bearish trend. Let's move to my screen to see it on the chart.
Alright, I believe we have come to the most interesting part of our session. Let's apply two EMAs actually, moving average exponential. I click once and twice to add two indicators. So I come to the settings of one, I make the length 100, set the source to average of high, low, close, and go to the style section. Let's make it a little bit bold. Blue line is okay. And we go to the second moving average exponential. We change it to 20. The source is, again, the average of high, low, close. And let's make it yellow, a little bit bold, so that it can be visible for us. Let's zoom out a little bit. Yeah. Let's start from here. Exactly what we have told you earlier. Let me see. Yeah. If you pay attention, in order to make it clear, the yellow line is my indicator with lower length, and the blue one is the indicator with higher length. Both of them with the same source and with the same settings, except their length, with one specific time frame. So, what we have told you earlier, I told you that if the moving average with lower length, I mean the yellow one here, is above the one with higher length, I mean this blue one, it can be a sign of continuation of a bullish trend. And as you can see, the price is coming up. My other drawings are also evident right now, and it's coming up. Now, let me disable them so that it will be much more clear for you. Okay. And here is the part that the price is, I mean, the moving averages are collided. I mean, this part. One sec. I mean, this part. This part is really vital for a trader who is trading with the indicator. Okay? So let's make it a little bit neat again. You can see that a moving average with lower length, I mean the yellow one, is coming below the higher length indicator. So it is a sign of bearish trend, and as you can see, the price has come down, has descended for a long time. And here you can see that it's going up again. It's a sign of bullish trend. It's another opportunity for trade. Here it is, the price is somehow, indecisive, so it's not recommended to trade in these sections. But here with a very big candle, the price powerfully, surpasses the moving averages, and it's going up. And we can see that the, lower length indicator has gotten further from the higher length indicator, which can be a very good sign of bullish trend. Again, there is a sign of bearish trend for a long time. As you can see, this much profit is waiting for you. Again, here the price, wanted to have a quick pullback. And then again, look at this opportunity. Look at this profit here. There are, thousands of small waves, thousands of small opportunities that we can get. I remember we sent, lots of signals for our premium members. And here the trend is changed because here is the collision point of two moving averages and the trend is changed. We can also see that the trend is changed too. Here is a quick pullback, but the moving average here tells us that it's going to be back. And don't worry, it's not, at the end of a trend, because if it was so, the moving average would come below this. So it's going up again. It's time to tell you a golden point here. You may have also realized by now that the more moving averages are getting further from the price, the probability of having a correction increases. It means by applying two moving averages, we can predict the price movement to a higher extent. For example, an EMA of 20 gets closer to an EMA of 100. It pulls back for it and goes up. So, as I see, the higher EMA gets further than lower EMA and price. So it will be probable that the price will have a correction so that EMAs will get back together and closer to each other. This means that the higher moving average can be a dynamic support or resistance line for the lower one. This session, we talked about some techniques of applying multiple moving averages on the chart and how to read them. The task that I want to ask you to do till the next episode is to apply multiple time frames on the chart and adapt the length. Use lower length for smaller time frames and higher length for bigger time frames, and try to memorize the appropriate length for each time frame. Also, check different assets by applying two moving averages and see how the price has reacted to the moving averages. The next session, we'll start to talk about price bonds and additional indicators. We are waiting for your questions down here in the comment section to respond them. Have a nice day, trade bravely.